Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Dividend yields have come back into focus in 2022 as investors are focusing on how much free cash flow a company's making, how much they're going to return, and not just growth. So I wanted to get together with Jon Quast and talk about some high dividend yields that we like today. Hi, Jon. How are you doing?
Hey, Travis, doing well. And high yield dividends is not a topic I typically talk about, but it is interesting.
Yeah, and I think we've got some interesting companies here. The one that I want to start with is one that I have kind of had on my list of companies to watch, but more so kind of waiting for them to stumble, and that's Best Buy. And one of the reasons that I think this is interesting from a dividend perspective is it seems like a lot of these retailers like Best Buy, like Target, who faced e-commerce threats for the last, 2 decades, have kind of figured out what their place in the market is. And I think that has given investors a little bit more stability and even shoppers too, right? Like, what you're going to get with Best Buy as opposed to, buying electronics online. And so as we move to maybe a more normal, steady state and e-commerce comes back to, we're not buying everything online like we were during the pandemic, and we just kind of go back to doing normal in-person shopping at a certain level and maybe some online shopping, Best Buy has become really attractive. So let's go through a few of the numbers here. 3.2% dividend yield. The stock's price to earnings ratio is 12.5. So retailer with a 12.5 price to earnings ratio, that's great. And revenue growth over the last 10 years is about 24%. So not a high growth company, but net income is up sharply over that period of time. So they have really figured out how to go from, okay, we need to grow, we need to keep growing a store base, we need to grow same store sales, to, what we really want to do is we want to just maintain what we're doing, and we want to grow profitability. Things like picking up at a store, ordering online and picking up at a store is now a great option. I think we're going to see more and more of that from retailers like Best Buy, because if you need a cable for your phone or for your computer, maybe I want to make sure that I can get it, so I want to order it online, but I don't want to wait 2 days or 5 days to get it. Best Buy's got a great place in the market. So it's one of these companies that you don't think about it as a really valuable player and like a value stock and a great dividend yield, but I think it is. And when you take a step back, it makes more and more sense to me. What do you think about Best Buy, Jon?
I think that my experience is what you just described. I recently did make some purchases at Best Buy because I needed some cables. I kind of knew what I needed, but I didn't know if I wanted the actual name brand or if a Best Buy brand would suffice or if an Amazon Basics or whatever. Ultimately, I wanted it fast. I wanted to see it before I bought it. And so I went to Best Buy. It's just down the road. And yes, e-commerce may have been a little bit more convenient, but the price is comparable, and I got it immediately, which is what I ultimately wanted. And so I've shopped at Best Buy for exactly what you've described, and I think that you're right. If it hadn't discovered what its place was, it would have been a terrible investment 5-7 years ago. It did figure out its place, it accepted it, it embraced it, and it's been a great stock for shareholders.
What do you have as your first pick, Jon?
So my first pick here for a high yield dividend stock is symbol QSR. That is Restaurant Brands International. It is the company that owns Burger King. It owns Popeyes. It owns Firehouse Subs, and it also owns Tim Hortons. There was the other one. And so big brand when you add up all the locations across that portfolio. It is looking for another fast food restaurant company to acquire. But here's what makes QSR really interesting for me. And I do want to preface this. Okay, so what is the dividend yield? 2.5%. That's high yield. The stock has gone nowhere over the last 5 years. It really hasn't. And so Restaurant Brands seems to recognize, hey, we're not delivering for our shareholders. And so what have they done? They've brought in Patrick Doyle. Now, some people will know immediately who that is. For the rest of you, I'll just tell you that Patrick Doyle was brought on at Domino's Pizza over 10 years ago. And he came in
Made him
at
a
a time
legend.
when he is a bit of a legend, because Domino's was kind of suffering when they brought him in. The product wasn't good. I remember one person saying, and Domino's actually embraced this as like their motivator. The box it came in tastes better than the pizza, or something like that. A customer said. Under Patrick Doyle, completely changed it around and started delivering on the product. That translated into wins for the franchisees. So the franchise locations have exploded higher in the past 10 years because people who operate a franchise of Domino's are saying, man, this is actually a good product now, and I'm actually making good profits. Therefore, they are willing to reinvest in that brand and grow it. And it has turned, during Patrick Doyle's tenure at Domino's, it was a 20-bagger stock. Now, QSR, Restaurant Brands, bringing in Patrick Doyle because they want to see the stock price go up as well. They want to see him in there and management making changes to the company. Now, I will caveat this. There are not the catalyst in place with Burger King and company that there was with Domino's. So, for example, Domino's traded at 10 times earnings when Patrick Doyle came in, traded at 40 times earnings when he left. So there's a 4x just in the valuation during his tenure. By contrast, Restaurant Brands International trades at a reasonable valuation today, the stock market average. I wouldn't expect a 4x in valuation over the next 10 years. It's pretty fairly valued as it is right now. However, what Doyle can bring, he can improve operations of the company. He can make the product better. He can help make it a better experience for franchisees who will then reinvest in the brand and push it forward. So getting a high yield dividend as it is right now, I think it's rock solid safe. Burger King is not going to be disrupted. Burger King will still be here in 10 years. You can take that to the bank. It will still be here. So rock solid company as far as the business is concerned. The dividend is high yield right now as it is. And you get a free wild card in Patrick Doyle being brought onto the management team and what he can do for that company. So I think it's an interesting play.
Question for you on one of the things that he did really well at Domino's, which is, I believe, primarily or maybe almost solely a delivery business. So you bring technology into the business in the form of an app, being able to track drivers. Pizza, it sort of technology made a lot of sense in the pizza business. And if I'm understanding his history correctly, that was a big catalyst for Domino's success for investors. Is there a game plan that he can replicate with these companies? Because they seem very different, but on the same token, it seems like, I mean, Burger King, there's one sort of near me, and it's always just kind of a sad place. So it's like, if somebody can come in and sort of rethink the business model and maybe do operations a little bit better, maybe make the food a little bit better, maybe there is a turnaround here the way that Domino's did. But is there something that like he did at Domino's that can easily be replicated, or is this all just completely rethinking the business?
I think it's interesting that you brought up it's kind of a sad place. And I want to put that in the context and help people remember, from the outside perspective, we see Burger King and we see it all as one big product. And that is how it is in a way. On the back end, though, you have these different people who are running these different Burger Kings across the country, across the world, and some are better than others at doing that. And so sometimes you do have a person who is running a Burger King brand, and they have just created a sad place, and it is not helping the overall company. If you go into a Burger King where you are and have a bad experience because of a bad franchisee, you're less likely to go to a Burger King in a different place that's operated by a different franchisee, because on the consumer experience, you don't know that. It's all one big thing to you. And so there is talk of rewarding the franchisees who are actually making the brand better and not rewarding the ones who aren't. So this isn't growth at all costs. If you are a operator of a sad Burger King, guess what? You're not getting incentives and you're not going to be granted more locations. On the flip side, if you are one of the better operators, guess what? We are investing in you very heavily to turn this around. So there is some some aspect of that. However, to your point, pizza is an inherently different business. It is why I think if you look at their portfolio of brands, you have burgers, you have coffee and donuts, you have fried chicken, you have subs. What are you missing? You're missing pizza. I really think that they do make a run at a pizza company at some point because they are talking about wanting to expand the brand. I don't know if Papa John's makes sense. I think that would be a blockbuster move. It would be hard to pull off, but I wouldn't be surprised if that happened. I think it would have happened better a couple of years ago when they were down in the quagmire of controversy and the stock was really cheap. I think that would have been the time to make the play. However, it's not out of the question. And then you bring that aspect in with Patrick Doyle. It gets really interesting at that point.
I wonder when one of these companies is going to rethink the way that we even lay out restaurants. Now that we're ordering more and more things online, it doesn't necessarily make sense that the physical structure is the same as it was in the 1950s. Why can't you talked about there's a whole bunch of brands there. Why do you need 5 kitchens for 5 different brands? Why can't we have one kitchen that is a much more effective use of capital? And then maybe the storefront or the delivery method is completely different. I don't know. I'm waiting for somebody to do that. And I haven't seen it done extremely well yet, but maybe
to your point. Doesn't Chipotle have 2 kitchens? They have one that is for the to-go portion of Chipotle, and then they have the other Chipotle kitchen that's for the front end. And I think that is even a way that you could go about this if you are Restaurant Brands International or Yum Brands for that matter. Mm-hmm. You have the kitchen that's dedicated for the location. So maybe you are a Burger King, and so you do have the one kitchen that is just Burger King. But then you also have the back end that does all of Restaurant Brands International's stuff from that one kitchen for delivery, like you said. And I think that
it's
could
like your
be
internal ghost kitchen.
Exactly. An internal ghost kitchen, and then you control the delivery as well, might be the way to go. And it might make more sense if you had more brands operating out of a single kitchen.
Yeah, I like that one. That one's it'll be interesting to see what he's able to do at that company, because obviously he worked some magic at Domino's. So we'll see if he can do it again. The one that I want to talk about is one that I keep harping on. I keep not understanding why the market hates this stock so much. That is Verizon. The wireless business is an oligopoly in the US. There are 3 major providers. Verizon is one of them. It has arguably the best spectrum assets. It has an incredibly profitable business, 7% dividend yield, and the stock just can't get any love from investors. It seems like every quarter management says something that investors sell off the stock. But when I take a step back and look at this, I mean, are we going to get rid of our smartphones or cell phones anytime soon? I think the answer is no. And then if you look at the business that's growing, I have been using their fixed broadband is what they call it. So it's basically just a router that plugs into the wall and gets its service from the 5G wireless. Same thing with your smartphone, and it just creates a hotspot in your house. Businesses are using this as well. They're adding hundreds of thousands of customers, and they're adding more customers each quarter. So growth is accelerating in that business. So what happens when you have a big wireless smartphone business and a big wireless fixed broadband business? Now you can start bundling things together. What makes sense in that bundle? Well, think about who's struggling right now. Streamers are struggling. What are they struggling with? They're struggling with churn. So it's very expensive to get a new customer. And then if that customer leaves after 2 or 3 months, you're actually losing money on them. So how do you get customers to not churn? You take the cable bundle playbook and you do it over again with wireless, and you bundle together these 3 services, including right now they have a bundle with Disney. So there are 3 Disney products, Disney Plus, Hulu, and ESPN Plus. They have another bundle that's available with Apple. I could see these bundles growing, and pretty soon your wireless Verizon subscription bill each quarter is $300 or $400, but you get all of your smartphones connected, you get your home connected, and you get all of the streaming that you could want. Now, you're not necessarily going to use it all, just like the way that you don't use every channel in a cable bundle, but the bundle ends up being valuable for both the businesses and consumers, because you don't have to manage 15 streaming subscriptions. So it's kind of a win for everybody. And who sits in the middle? It's Verizon. And so I think they're really well strategically positioned from a valuation perspective. They're just a great stock, trading at 8 times earnings right now. And like I said, a 7% dividend yield. So that's one I really like right now. What do you think about that one, Jon?
I mean, so the cell industry is not one that I follow at all. And so I'm hearing a lot of this information for the first time. It is interesting if it is a very safe business. And I would assume from an outsider and from what you just explained that Verizon is a very safe business. Trading at that low of a valuation with that high of a dividend yield, it becomes extremely hard for an investor to lose money over a long period of time, right? So if it's stable for the next 7 years, if it's stable for the next 10 years, the business itself, if you hold it over that time frame at that valuation and at that dividend return, I don't see how an investor loses money, and why something like that is very, very interesting and worth looking into.
Yeah, and it's one of those, I think we need to not have growth stock expectations, but look at what you're paying for the company. Even if they just do, like you said, nothing and just pay a 7% dividend yield, and the stock doesn't appreciate, it's still a winning investment. So what is the next one that you have for us, Jon?
So I want to talk about Tanger Factory Outlets, symbol SKT. This is a real estate investment trust, a REIT. And the reason that I like Tanger Factory Outlet is because of where it is right now. This isn't a company that I would always invest in, but it's kind of a special situation in my opinion. So currently yielding, I believe it's 4%, the dividend right now. However, a real estate investment trust is required to pay over 90% of its earnings to shareholders as a dividend. And so if you go back before the pandemic, this is a company that operates outlet malls, right? It leases the spaces to its tenants. These are retail companies like shoe companies or apparel companies, all sorts of stuff. The spaces are filled in 2019. Business is going well. They're paying out, at the time, it was 62% of their funds from operation. It's kind of like cash flow for real estate investment trust companies, paying out 62% of the earnings as a dividend, or of the cash flow, the funds from operation. Okay, then what happens? The pandemic happens, right? There is not in-person shopping for a period of time. The financials do get wrecked for a period of time. However, the company does what you do in a situation like that. It manages, it shifts things around, it makes concessions, it stays afloat, is the takeaway there. And so they stay afloat, they are fixing the financials, and now that everything is opening back up, I actually just drove by a Tanger Factory Outlet over Thanksgiving weekend. There's one on I-95 in South Carolina. Drove by, it is absolutely slammed full when I drove past. And so retail activity is recovering. In-person brick and mortar retail activity is recovering, and the business of Tanger Factory Outlet is also recovering because of this. Now, what gets interesting is the dividend has not fully recovered yet. They're still, on an earnings perspective, it's not completely healed, right? They're still doing some things, but on a cash flow perspective, it's coming back. Cash flow year to date, the funds from operation up 63% from the comparable period of last year. So a big jump. They're only paying out 43% of those funds from operations right now. They were paying over 60% before the pandemic. So you start doing the math here. It's high yield right now. The business is recovering, and very soon they're going to be required from an earnings perspective to start paying out those extra profits to the shareholders. And so if you buy today, yes, you get the 4% today. It's not out of the realm of possibility that you're going to be getting 7%, 8% on your cost basis in a year from now. So it's kind of a special situation that I like.
The other thing to add to that is that there's often a lag with real estate. If a mall like that, an outlet like that, is really successful, if it gets really busy and the businesses become really profitable, that will eventually flow to higher rents to the owner, but it doesn't happen immediately. It happens the next time that lease is renegotiated, unless there's some sort of revenue kicker in leases, but that's not typically the case. I don't know if it's the case for this company, but that's not real common. So, that's something where as long as the outlet business, the mall business is picking up, it will be tailwind for 5 to 10 years potentially.
Absolutely. I agree.
All right. Well, there are our high yield dividend stocks. I had Best Buy and Verizon. John, what did you have?
I had QSR, Restaurant Brands International, and Tanger Factory Outlet, SKT.
All right. What do you think about those? Leave a comment in the comments section below. Of course, follow Rive Investing. We would appreciate it, and we will be back with more content. Give this video a like, and we will see you here next time.